there's uncertainty for how and where things are going. So where you can be here with flexibility to be able to pounce on the opportunities is having that liquidity. So the deferred sales trust, probably one of my favorite things is to be able to pay off debt, diversify your wealth, but be in a liquid position to buy assets. In fact, one of the stories for this, it's a powerful one that I learned, unfortunately, through the crash of the 2008, real estate and kind of great crash of '08. And that was people who had overpaid for property in '05, '06, '07, did a lot of 1031 exchanges just to see themselves have too much debt, not enough liquidity, and not enough diversification to lose a lot of their wealth. Had they had the deferred sales trust, they could have, really got rid of all of those challenges and then been able to invest back when the market shifted. Same thing with cryptocurrency. A lot of people didn't know about the deferred sales trust. We did have a few clients use the deferred sales trust for their crypto exits before kind of the crash. And so they weren't diversified, right? And they felt trapped by capital gains tax, and they didn't realize that they could just go back and buy cryptocurrency at a lower price, all tax deferred, using the DST. Had they had the liquidity exiting out of cryptocurrency and have the powder dry. And so the enhanced liquidity is an entrepreneur's best friend right now in times like this, as well as being out of debt. We're up with the last two. The last two for flexibility, the deferred sales trust, and why do you want to consider it, is the ability to have a customized payment structure. So the DST can be tailored to individual needs, and those needs could be, for some of our clients, they have an earnout over a couple year period of time, where they are selling their business and they're staying on for a few years, and they have an opportunity to get an increased number. But in those 2 years, they're still getting paid like a salary. But then in a couple years, they're retiring or moving from that business, and their salary is going to zero. We can customize the payments to be stalled for a couple of years, meaning that the accrual of the interest on the promissory is building up, the investments are still, building up, yet you're not having to take payments from the trust until a later date where you need or want some of that cash flow. It can't go on forever. You definitely need to take something. We typically like to say within about 24 months, take some of the interest payments from the trust, but it can be stalled for a couple of years. And the last flexibility, which we love, is estate planning benefits. A lot of the previous estate planning structures that you might be aware of have to do with buying a lot of life insurance, having to do with gifting it away to a lot of kids, having to giving all the way to charity, and or just holding on to the assets to maintain what's called a stepped-up basis, so your children can have the benefit of the same basis at your death, meaning they're not going to pay capital gains tax on anything at that point if they sell it basically after a few days after you die, or within the time period where the value is still the same. That means you don't necessarily get out of the toilets, trash liability, and all the day-to-day headaches. Whereas the deferred sales trust, what's nice is we can eliminate all of those challenges. We can move funds outside of your taxable estate. We can have the seamless transition for the assets to children in the sense of a promissory note paying cash flow. You don't have to buy any life insurance, and you don't have to gift it all the way to charity. So the deferred sales trust can be a unique, flexible plan for your estate plan purposes, giving you as an entrepreneur and investor greater control over the cash flow of the assets, and essentially aiding in a seamless, as seamless as possible succession plan. That being said, if you want to take action, you can go to capitalgainstaxers.com. I'm going to open it up for a lot of my strategic alliances that I have joined and or some potential clients that are here today. Thank you so much. If you have questions along the way, put it in the chat. If you're curious on how to join this mastermind, you go to capitalgainstaxers.com. Hey, I do see Jake Miller. I did a minute ago, but I do see Micah today. Micah, how are you? And anything stick out from that little monologue that I just put on here?
And it was a great monologue indeed. No, I mean, I really like how the deferred sales trust just really opens up your capabilities of deferring the sales tax or deferring that capital gains tax down the road. I mean, you're not going to eliminate it. It's not going to go away. It's not like we're going to take an eraser and make it smudged out, right? It makes it to where you don't have that taxable event right now. And that has a ton of power, because then you can invest in the meantime. You can help it to grow instead of getting that haircut right off the top.
Absolutely. It's the law of compounding interest, right? The eighth wonder of the world, I think, is what Mr. Albert Einstein said, the ability to compound interest on what you would have paid to build wealth. And it's like a zero interest loan from the government. Think of it kind of like an IRA, kind of like a 401k. What do? You forego taking or spending it on personal stuff now. You put it into the trust or into the retirement account, and it has the ability to grow and compound. And if we use the law of compounding interest with a 7% compounding rate of return, within 10 years, that amount will double. So let's say you sold a $10 million asset, and let's say the trust was structured at 6, 7, 8, or 9% compounding, and hypothetically, you took no payments, you would have paid, let's say, 30 or 40% of that would have been taxed, $3 or $4 million. And hypothetically, you took no payments for 10 years, that 10 would jump into $20 million. Now, the tax liability would still be the same, 3 to 4, although it could shift in that capital gains tax rate should go higher or lower, most likely to go higher, or maybe stay the same. So that could happen, right? The other thing would be the ordinary income tax that is produced. You'd have tax on that. But the idea is if I can use the government's money to create and preserve more wealth, slowly take payments over time and pay tax, and it's the idea tree falls in the forest and no one's around to hear it. Does it really make a sound? Well, in this scenario, if you never dip into principal and you only live off interest payments, if that's where we can set up the cash flow, in one sense, yes, you're not eliminating the tax, but you're still deferring it. Now, the neat part versus an IRA has to do with the fact that there's no required minimum distributions, although we do like to see some distributions within the first, starting in about year 2 at least. And that does show that there's intent to live off the interest and not just defer forever, right? So there's some nuances there, but otherwise what we're saying is unlock compound interest, use what you would have paid to the government to grow your wealth, and also invest back into other business ventures with you. So as an entrepreneur or an investor yourself, you might want to buy real estate or businesses. You might want to do a startup. In fact, Micah, one of the deals we just did with a joint client with Jake Miller, who financial advisor, one of our top ones who work in the country. The client, she was selling $5 million of Bitcoin. Now, this Bitcoin she had bought at a very low basis, about 50,000. It increased to 50 million. Her vision for her wealth was to sell at a good price. We sold it at 54,000 a coin, deferred about 1.85 million of tax, and she used about 4 of the 5 million as a seed capital for a startup online educational platform business with her college roommate. So she went from working for building the dream for a big tech company in Silicon Valley to giving back and making a difference in her own way, building her own dream with her college roommate with the use of the deferred sales trust, all tax deferred. So, Mike, any thoughts on that deal, if you remember that one well?
Oh, that was amazing. Well, and what you're talking about too, that diversification. So, and I mean, there's a lot of folks that go into a deferred sales trust because of real estate. I mean, you've talked about crypto or selling your business, right? It's really diversified. You can put into it a lot of different types of assets, and but you can also use it in a way that it's not limited, like a 1031 would limit you to only going into a like kind investment. In this situation, like you're talking about, she was able to do some in marketable securities. She was able to do some in a business for her college roommate. Like it's very diverse.
Absolutely, and which leads into some of the objections that you might be thinking about, which is like, wow, this sounds too good to be true. It seems like what's the catch, or is this really legal, or why doesn't my CPA know about it? And these are things that we help people through every single day, but we'll give you some details here right now. Close to 30-year track record now for deferred sales trust, thousands of closes, billions of assets have used it for selling. And here's the biggest one, I think, the 24 no change IRS audits, which to me is the most important part of this. You want to make sure that the tax and legal professionals that are representing you are able to defend and have defended the structure, the strategy, whatever strategy you're looking at successfully, right, over decades, not just a year or two or a few hundred transactions or something like that. It needs to be something that has withstood the as the gauntlet of change, of political change, of taxation change, and has a foundation. And this scenario, IRC 453, which is an installment sale, is it's part of the tax code that goes back close to 100 years. With that, the deferred sales trust is batting 1,000, has never had a single change. Also, third party, tax preparers or law firms have reviewed it. Third party, former IRS agents that are tax attorneys reviewed it. Green light. It has a private letter ruling, and so it's batting 1,000. In fact, we call it the most vetted tax deferral strategy your CPA has never heard of. That being said, we want to encourage your CPA, we want to encourage your tax professional, we want to encourage whoever it is that is helping you with your exit to come alongside during our no-cost due diligence. We will open up our playbook. We will open up our track record. We will walk through with you and them step by step how it works. All no cost, no obligation for you to use the trust. They do probably need to sign an NDA at some point if we get too deep into some of the weeds. And you're under a conditional engagement agreement, which is just conditional. So we want to open up that playbook. So that's the legal aspect. Hopefully that gives you some confidence of that it's legal, it works, it's never not worked, as long as we work with professionals who know what they're doing. By the way, that's our role. If you're curious, we're not a CPA, no tax attorney. We're a trustee. Trustee is a key component of the deferred sales trust, which is third party unrelated to you. It's what creates the opportunity for the space between what's called constructive receipt and actual receipt. We're kind of like a qualified intermediary. If you've ever worked with a 1031 exchange company where the funds go to a third party and it allows you to defer the tax. In this scenario, you're actually selling the asset to the trust in exchange for a promissory note, and the trust is ultimately selling it to the final buyer. But here's the key: the trust bought and sold for the same price, so there's no tax at the trust level, and you receive a promissory note to receive payments slowly back over time, tax slowly over time. And so that's how basically this thing works, right? Mike, any thoughts on the legality part and some of the things that people might be thinking, or anything I should address there?
Yeah, actually, there was a comment in the chat that talks about the installments because you were bringing that up. So, Wesley, if you wanted to unmute, you can, but we're going to go ahead and talk about this, because you talked about getting interest in 24 months. It's not always within 24 months. It's kind of how it gets structured in the event of the sale itself. But his issue was if you waited too long to actually receive those installments, right, Wesley? Is that kind of...
That's correct, and I don't know that it's the major issue for us. I was just curious if that raises some kind of red flag and opens you up to scrutiny if you're not actually taking installments in the short term.
Yeah, great question, Wesley. And so the answer is, it's not like a black and white. It's not as if the IRS says, hey, we've had these guidelines like the 401k or an IRA, like an IRA, there's a required minimum distribution at a certain age that you can just start taking. That's part of that strategy, right? That tax code. With the deferred sales trust, what we found is during the audits, which have all been successful, there's been clues and there's been little nuances that we've shifted over the years. One of them in the beginning was like a 20-year note of which payments hadn't been paid for like 9 years, and it was going to be paid in year 10. And during that audit and during that discovery, the IRS said, hey, is this payment coming out? And they're like, yeah, it's coming out next year. And from that conversation, the creator of the structure, Todd, said, I think it's probably wise to have somewhere between around 2 years, some payment coming out, which shows the fact that this is tax deferral. It's not. It couldn't be construed as tax avoidance, right? And so that's just best practices. Now, if you don't take payments beforehand, we don't think that's unreasonable or not defendable, because what would two unrelated parties do in a circumstance? So if Wesley, you and I were doing a deal, this is a kind of a way to think about it, how the IRS would look at this too. Hey, if there was two unrelated parties doing a seller carryback, what would be commercially reasonable? Well, no interest payments for 2 years would be commercially reasonable. That didn't seem unreasonable. And then some interest payments after that. But would no interest payments for 10 years be reasonable? Probably not, And so that's the thought pattern, right? Or the common sense behind it. And so that's how we try to practice to stay on the, conservative side of what can be construed as as either tax avoidance, such as tax deferral. So hopefully that answers the question, Leslie.
It does. Thank you. Appreciate it.
Absolutely.
Well, and we like it on the investment side because then we have at least a couple of years to invest the funds and get some of that interest growing and rolling and gaining speed, right?
Absolutely. In fact, as you continue to bring in Jake Miller, certified financial planner, served in the military, entrepreneur extraordinaire. Jake, how you doing today, sir?
Doing very well, Brett. My goodness, you always make me sound so important.
Well, you are important because it takes a team here to execute this. It's part of why it is perhaps deemed to be a little bit more expensive than you might think, and we'll talk about that here in a second. But Jake, talk about just the flexibility of the investments, like Michael was saying, the ability to grow in a very tax efficient way for even a year or two while the payments are being delayed.
Absolutely. So essentially, a couple things are really important for you to understand. Once you're eligible for a DSD, which means that you have a qualifying transaction that is typically $1 million or more, at least a substantial amount of capital gains tax that you're trying to defer. When you have the eligible transaction and you have the DSD, and the funds go into the DSD, you are now not only an accredited investor, but also a qualified client. And you receive that status because of Brett Swartz, him as the trustee. What does that mean? That means that now the entire world of investment opportunities are now open to you. And so things that you didn't even know about before, you can now invest in. You can give promissory notes to other people who have business ventures. Your trust can invest alongside you as a passive investor. You can invest in Reg D or private placements. Essentially, we have clients that have invested out of the country, in real estate, in businesses. They've taken advantage of warrants, contractual warrants. They've done a number of different things. Now, that doesn't mean that you have to be so fancy either. If you like, inside of your deferred sales trust, after properly analyzing your objectives and your goals, we can invest in the stock market. Last couple of days, it's been a little bit rough in the market. If you want to take away some of that volatility, we have private debt placements as well as private equity placements that can provide you a more consistent rate of return, understanding all of the risks associated with private investments. And we have a whole slew of that. To maybe illustrate it better, Micah did a portfolio illustration for an individual just the other day. This individual has a 12% debt investment. This individual has a private equity casino investment out of the country. This individual has a real estate fund that they've put money in. This individual also has a dynamic portfolio allocation in the stock market. All of these things is the makeup or the pie chart of what the individual has invested within their portfolio based on their goals and objectives, their time horizon, and what they told us they wanted the money to do. A lot of times this doesn't happen all at once. It's sometimes 4 or 5 or 6 conversations to establish who you are, what you want your money to do, and what you're comfortable with. We always encourage greatly that our clients become incredibly educated in all of their investments, whether it be in the stock market or whether it be in private investments. And we try to facilitate that educational process so that you know all of the risks as well as you understand and you're well informed with proper communication ongoing what your investments are doing.
Excellent, Jake. By the way, I like the background. Wherever you're walking in the circle there, man, it's got like a cool wall there with that big R.
That's right.
Like a big A right there. But what's going on over there, man?
Well, here we're in Guadalajara, Mexico. We actually, one of our investments, private investments that will be releasing here soon, is a co-packing plant. So all of those drinks in the store, whether it's in a can or a bottle or what have you, even if it's bottled water or energy drinks or whatever, all of that comes from a co-packing plant. And so people send the recipe to like a distillery type facility where it's all mixed together and it comes out into the bottle or the can or whatever. And they've also purchased 2 tequila brands, a seltzer and a few other things. So they've vertically integrated into their supply chain, and it's now a new opportunity for investors that will be available in about 2 or 3 weeks.
Fantastic, Jake. Thank you for the great overview and the detail. And so hopefully you're gleaning how flexible this can be for you as the investor, the entrepreneur, and get a sense for how the team works together to bring amazing options and help you make great decisions. So I talked about fees, so I want to make sure I live up on the promises. So what are the fees? Right? What does this all cost if you were to work with myself as the trustee, Jake Miller as the financial advisor? We also have another financial advisor who's going to talk here in a minute. Jake Carpenter is a part of the Strategic Alliance Network with Capital Gains Tax Solutions. But essentially, it's about 1.5% to 2% on a recurring basis on what we call the AUM, or the accounts under management. Simple way to put it, the net proceeds into the trust. So let's imagine you sold a $10 million asset and you had $3 million of debt, and you had another partner who had $2 million that was owed to them, and the net was, let's say, $5 million into the deferred sales trust. On that amount of money, our goal is typically to return 6, 7, 8, or 9% compounding net of the recurring fees, which are about 1.5% to 2%. Now, on $5 million, you do get a little bit of a break, just depending on where the funds are invested. But that's a good kind of rule of thumb to keep it really, really simple. It's about 1.5% to 2% on the net proceeds. Now, let's imagine that one partner wants to do the deferred sales trust. So it's a $5 million trust, and the other partner wants to do a $2 million trust, right? In that scenario, that individual trust would be separate from you. So can partners separate? Yes, that's a neat part about the deferred sales trust. It's flexible and seamless partnership separation, whether you're S Corp, C Corp, LLC, whether you own it in your individual name, whether it's already inside of a living trust. The deferred sales trust can essentially purchase your interest prior to the close of escrow. In exchange, you receive a promissory note. And so it's flexible there. Regardless if you go back, the investments go back into your own deals or passively or 100% into like the stock market, it's about 1.5% to 2%. Now, there is a one-time fee that's separate to this that goes to the tax attorneys and CPA who created the structure, the law firm, the CPA from there. And that's essentially 1.5% on the first million, and then 1.25 on anything above. However, that's on the gross sales price. The gross sales price, and that's part of why we also have the minimums of $1 million net proceeds, $1 million gain to make this make sense. So as long as, like Jake said, you're eligible with that qualification, and you also don't need or want all of the money right away to spend on a bunch of personal stuff, you can use the deferred sales trust to defer that tax and invest into businesses with you or passively into the stock market, into real estate opportunities, into cryptocurrency, right? A diversified way that fits your risk tolerances. And this is part of how we all work together to make it make sense for you, which leads into the next, maybe most important question a lot of people ask. We covered fees, we covered legality, we covered some of the roles. The next one would be control, right? As entrepreneurs, myself, Jake, everyone on the calls, if you're entrepreneurs or investors, we are what's called typically, as Americans too, or really anybody, but rugged individualists, right? Meaning we want unilateral control our own destiny, make the thing happen. And we love that. Now, the deferred sales trust, you are giving up some control, right? It's not unilateral control, meaning you can just walk in and get all of your money all at once. You can make unilateral decisions to invest into things. It does take working with the third-party trustees. That's me, our company, Capital Gains Tax Solutions, to vet and look at opportunities to approve of the investments alongside of you. Here's the other side, though. We also do not make investments without your approval. Funds also don't move without your approval. Control also could be construed as, well, I don't know the funds protected, right? Well, you have 24/7 access to view the funds online for any of the liquid investments. There's reports, there's tax returns, there's financial reporting, there's a lot of groups that we work with to provide transparency and accountability with the investments. But you do have to work with the trustee, right? And now, I also say choose your control. And Jake Carpenter, this would be a good time for you to come in as well. And I say choose your control, because choosing control is you can control all of your 5 million, but let's say you would have paid 30 or 40% in tax, and you can do the math on that. About, let's just say it's 30% on 5 million. Let's imagine you had a zero basis. That's a $1.5 million tax. So you could say, hey, you can have unilateral control. It'll cost you 1.5 in tax, or you can have indirect control and have 5 million working for you. Jake Carpenter, any thoughts on that? You want to add or subtract or kind of fill in? If he's still there. Otherwise, we will go back to the Jake Miller. Jake Miller, any thoughts on that? And you want to fill in there?
Yeah. Sometimes people get caught up in the whole control thing. This strategy does take a team of people to make it work, and you then become part of the team ongoing, or we become part of the team ongoing. And typically, that's for the benefit of all. Once you are doing something that you've never done before, and it's kind of like a level up from where you've ever been, you should expect to need these specialists or these people with you to help you make it happen and to keep you out of dangerous waters, so to speak. This strategy, Brett, it's been around 26, 27 years. It's been audited. I jumped in when you guys were talking about the audits that it's had and everything else, and how it has a 100% track record, everything like that. This strategy has been protected from abuse or misuse. I mean, think about making cookies. If you use salt instead of sugar, the outcome is different. And so you need people that are helping you stay within the guide rails when you're using the deferred sales trust, so that at the end of the day, it accomplishes what you wish to have it accomplish. And that's what we're here for. Nothing more, nothing less.
Perfect. Absolutely love that. And so now I want to open up for questions for anyone. If you want to take action, you can go to capitalgainstaxsolutions.com. You can also go to strategictaxsolutions.com. Each one of those, one will go to Jake for Strategic Tax Solutions, and the one will go to me. But we connect and work on deals all the time together. But anyone have any questions or thoughts? It looks like Wesley might have a question. Go ahead, Wesley.
Yeah, I had one. It's kind of regarding being a guarantor in a loan. Are you able or unable to use the assets held within the trust to secure debt?
Yep.
I'm still trying to understand that order of the trust for funds held within it versus funds held without it. Like if you're a guarantor for a loan, are those assets held within the trust at all usable to secure debt?
It all depends. It depends on the bank. I think it depends on the deal. Let me just tell you what I have seen for clients of mine, okay? I've seen clients of mine say, hey, look, I have Mr. Bank, here's my balance sheet. As a part of my balance sheet, I own this promissory note. This promissory note is paying me out these monthly payments, and the total amount is there. And I've seen said bank say, great, that's a part of your overall net worth. Based upon that and a number of other factors that are a part of what's called the global debt coverage ratio, if you will, and also the debt coverage ratio on the actual asset and how much they balance those two in between, and your debt as well, and how that looks with your income. Say, okay, great, yes, we can see the trust owes you the money, you have the promissory note, you're getting the payments, you're getting the income, therefore we'll make a loan based upon that. Okay.
So they might use the actual schedule of installments as the evidence of the income.
Yes, I've seen that, and you can't say it's blanket for every bank or blanket for every deal or blanket for every individual. I've seen it different ways. I've also seen it where they'll look at the promissory note. I had one client, we sold a property out of Walnut Creek, a commercial real estate asset, and they were wanting to buy a primary home in San Luis Obispo. And so the bank looked at the promissory note and said, hey, that's great. Looks like it's owed to you, but there's no payments that are coming out right now. And so we were able to amend the promissory note to start making payments. And by the way, their overall income had a certain income over here, and they wanted to buy a property that needed more income to qualify them for the loan. So we were able to adjust the promissory note to start making payments sooner than they had anticipated they needed or wanted it. That moved them up into a spot where they qualified for the loan. Guess what? The property closes. Can we then adjust the promissory note back down? Yes, right? And so there's some creative ways to try to achieve financing using the promissory note, adjusting the promissory note. Jake Miller, you want to add anything that you might have something to say there?
Yes, I think that the only reason we have to be a little creative in that in some of those circumstances is we don't want it to be perceived that the trust is just an ATM. If the trust were just an ATM, then you've already taken constructive receipt because you have easy access to the money at any given time, and that the trust, this shell of the trust, really doesn't have any walls or windows. It's transparent and it's open. If that were the case, then it would be taxable to you now. And so we want to make sure that the use of the trust has some layers to it, and that's why we have a variety of different ways that, or guidelines, to ensure that if you need collateral or you need to prove income or prove assets, whatever, for financing and funding, so that as the trust partners with you to invest in more and more things, that it's bulletproof. If anybody questions what you're doing with the trust, it truly is its own entity in and of itself, and it acts separate from you as a person, so that you are not taking constructive receipt.
Okay, great, thank you. And so, in some sense, it would be giving us advice on, a way of doing this in which we are clearly defined as not having full access to money.
Yeah, we'd make sure not to step on a landmine, right? For you, Wesley, but also for us too, and all the clients that we're helping out, right? And for the structure and strategy itself. So there's guidelines in place. At any given point, there's a promissory note set to pay you out over a period of time, but it can be amended and adjusted at different times. Talk with me, and we can work that out. So, hopefully that answers the question. Any other question on that, Wesley?
Thank you. No, that's it. Thank you.
Cool. Excellent. All right. Anyone else have any questions? You can put in the chat. You can also raise your hand or unmute yourself, and we're happy to answer those, whatever they might be. By the way, if you want to take action right now too, we do have the book that came out. It's on Amazon, Building a Capital Gains Tax Exit Plan. It's the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or for your clients. The Jake Miller is in the book. I do also have a few chapters as well. And then we have the Kevin Harrington from Shark Tank in the book. That's pretty cool, right? We love that Kevin's in the book. Thank you, Kevin, if you're listening to this. And so, yes, any questions from anyone with us today? You can unmute yourself or put it in the chat. And otherwise, Jake and I can just keep talking. Maybe Micah, I haven't heard from you in a few minutes. Any thoughts on anything we've shared here, or any questions that you might have, or someone might have, you think, that we can answer?
Yeah, no, I do. I think both of you and Jake had both kind of hit on it a little bit, but I love that the Deferred Sales Trust has this type of a track record. And it has this type of a track record because the people that are so dedicated to it, right? There's only two strategies that we help people with that have a no contest, no changes in their history, and that speaks volumes to the strategy itself.
Awesome, thank you, Mike. It looks like Jake Carpenter might be ready to hang out here. Jake, are you off of that $100 million call, and you can talk with us now?
My apologies, I've been in and out, so it's been kind of a busy Friday, but yeah, I'm here, and so I think there's a lot of power in the flexibility and the positioning that we can use with the Deferred Sales Trust. It's not the be all end all, but it can be a cornerstone, a keystone element that Jake Miller always says that can allow us to build, retirement planning and estate planning and business succession, wealth transfer, income strategies off of. It's very flexible. It's very friendly when it comes to someone that really qualifies for the strategy. And that's what we're here to do. This team is here to surround the people that are selling highly appreciated assets, engage with their professionals, help them do the due diligence to make sure that this is an appropriate strategy. It's going to work both now and in the future for them, whether it be addressing federal estate and state estate tax issues, dropping a lot of money out of the estate and closing with the 2.0 version of the DST, or whether it be just using the straight up DST, which falls under IRC code 453, which is nothing more than an installment sale. So we're here to engage with your CPA, your attorneys. Brett and I were on a call yesterday with, I think there were 6 or 8 professionals on there. including the individual that was selling. And, we were talking about the details, the devil's in the details. So we got to make sure that we really flesh out the details, that your CPA understands it, your attorney understands it. We had both CPAs and attorneys that were representing the potential seller on the call. And they were really fascinated in getting up to speed and understanding how this thing works. And I think that, the linchpin is what Jake Miller said. It's got to be an unrelated party. You cannot have constructive receipt. You cannot have direct access. As long as we structure things appropriately and follow the rules, then that's what keeps us out of trouble, and that's what keeps, like what Micah said, the good track record. So.
Very well said, Jake. Thank you so much for sharing. And I think it's important to understand too, our team is here, honestly, a lot of times to find out if there's another way. Like you might have some carry forward loss, you might have a great 1031 exchange, you might have a debt over basis challenge, which means you need to do maybe a partial Delaware statutory trust if you're eligible with an investment real estate property. In other words, we're here to give you options, capital gains tax solutions, plural with an S, right? Options to see what's the best fit for you and your family and your legacy and the team that you're building to see if it's a win-win. Oftentimes, deferred sales trust is the number one and the most used, but realize that the key is to figure out what are your options so you're making sure you're making a great decision, and you have a team of professionals that are helping you have a tax flow mindset as well as a cash flow mindset, and as well as building and growing that wealth to leave a legacy. And when you combine those things, it becomes a powerful way. And we thank the government for bringing us together here today, because if we didn't have any capital gains tax or income tax, laws, none of us would be here. So in one way, it connect us, right? But at the same time, it's a call and an opportunity to be great stewards with the wealth that you created or that you've earned, that you've built, and we want to come alongside of you to guide you and help you on whatever path you're leading with the future of that wealth. So thank you so much. If you're listening to this now, if you're already a client, thank you for putting your trust into us to be great stewards alongside of you with the wealth. And if you want to take action, you go to capitalgainstaxsolutions.com. I'm wondering, Micah,
I've got a question for you.
Okay, go.
So sometimes people will come and they'll say, well, I understand that I have to have a trustee that's not a related party, but tell us a little bit more about what you do as a trustee and why you're a trustee and why there may be limitations to other people becoming trustees.
Yeah, absolutely. I think the key here of why you might want to hire me as the trustee is I really try to be the link and or the conduit or the guide between what you're trying to accomplish and where you're at today. And let me get a little bit backing up a little bit. I've over my career, I've helped sellers exit mostly multifamily investment properties, and of course deferred sales trust transactions and some Delaware statutory trust transactions over about $500 million. I also grew up in a real estate, really hands-on, solving problems, building assets in the Bay Area. And so my role, as I try to say, is I'm like a real estate investment advisor. Like a financial advisor would be maybe globally on everything, and especially securities. Mine's really real estate focused. And I say I like to be more than a trustee. Another analogy we use is you don't want 5 Steph Currys. You probably want a Draymond Green, a Steve Kerr, a Steph Curry, a Klay Thompson. You want different professionals with different sets of skills that complement one another. My favorite part of all of this is I get to work with amazing people like Micah, like Jake Carpenter, like Jake Miller, the tax professionals, the group who created the structure, and really just work on a team. To me, it's just such a blessing and such a thrill to be able to learn from a lot of really amazing, smart people and be a part of that and help to build that. I played basketball and football growing up, played basketball in college, and so to me, it's like a team sport, right? And each of us has our role and our expertise to help unlock the outcome for you, right? Which is number one, always what we're focused on. What is it that you're trying to achieve? Clarifying where you're at now, and then bringing in the best of the best to make that bridge. We're all kind of holding, let's say each other's arms, and that becomes the bridge for the ideal outcome. So, Micah, hopefully that answers the question. Appreciate you teeing that one up for me, and any thoughts on that?
No, that was perfect. I loved how you were talking good about the team and everything like that. But why is it that somebody can't just say, "Hey, this is my brother-in-law or my cousin or someone else"?
Great question. So there's a thing called a related party, right? And basically, where there's it's basically what's called constructive receipt or too much control. Where if you wanted the trustee to be a brother-in-law or to be a former employee, the structures that have failed in the past, the biggest thing is they thought they could get away with trying to hide the control. Like, I'll just have my secretary outside my office who's not related to me, family wise. She's worked for me for 5 or 10 or 20 years or whatever, and she'll just sign off on everything that I tell her to do. Right. So in other words, there's no gap between decisions being made and execution of movement of funds. And that's what creates the tax if you have too much control. Some people want to have only the secretary or their son's roommate from college is another one that I think got blown up, right? Where they're like, okay, son, my son, he graduated, he had an amazing roommate. We'll make it that person. And so it's just, all of that never ever works. It'll never work because there's too much control. Now, there are some controls we can put in place, right? We can have co-trustees. This is kind of a nuance here for everyone who's curious. It's more expensive and there's more paperwork, but that is something that we can put in place. We could have like trust protectors, when one does just the authorization of investments, the other one does just the authorization of fees. It creates more complexity, perhaps even more comfort for you. So that is all possible. So I guess the question would become, what is the objection to the third party trustee? How do we help you overcome that objection and get comfortable? Or how do we build in controls in place so that you feel great about this relationship? I'll add one last thing here. We actually think that the entire structure and strategy, because if you haven't noticed, capital gains tax solutions is different from Jake Carpenter. It's different from Micah and Jake Miller. It's different than the law firm who created this. It's different than the tax preparer who does the tax returns. It's different than maybe the investment real estate companies we work with. In other words, we're all separate entities, which creates a level of accountability and transparency and kind of like watchdogs, all of us looking over each other's shoulders and looking out for one another, right? Not so much for looking for bad things, but looking out for making sure that the structure stays in place. And that's a good thing, right? It's a good thing to have multiple parties that have their expertise that are all under one roof to make sure that we're doing what we should be doing and we're doing what's right and transparent. So hopefully that answers the question, Micah, or any additional ones there.
I would just add, Brett, if you don't mind, a lot of times people don't go to the extra hassle and extra expense of some of these safety protocols as a protector or a co-trustee or some of these other things, unless the dollar size warrants the additional attention and the additional security. So when I say the dollar amount, I mean, we're talking $30, $50 million and above. And even sometimes the dollar amount isn't a telling factor. It's the complexity of what they're trying to do from an estate planning standpoint. And so a lot of times those are more indicators than anything else to enlarge the already robust team of people around you with the DST.
Very well said. And so we're here to help you work through all of the complexities and all of the facts with the Deferred Sales Trust. Again, you can go to capitalgainstaxsolutions.com or strategictaxsolutions.com, or even Jake Carpenter's Carpenter Capital LLC. So we're getting close to the end here. We've got about 12 minutes left. We did have a new gentleman join, so welcome Alec. Feel free to unmute and ask any questions you might have, or anyone else at this point. We're already in the Deferred Sales Trust. We're just talking about the flexibility when exiting $1 million assets, using the Deferred Sales Trust to grow your wealth, preserve the capital gains tax that you would have paid, and to have flexibility to do the things that you're wanting to do with your wealth. And so, Micah.
Wesley had a question.
Oh, Wesley, go ahead. Yeah.
Yeah, sorry, I got lots of questions today.
It's fine. That's good.
I was just kind of curious, how much a client or how much your clients typically are able to lean on your advisory council and your team of professionals. And, one from the perspective of, obviously their time is valuable and costs money and how much of that access is built into the fee? How much can we expect to be able to strategize with them? And on that same note, if you're working with them substantially to direct the investments, how much direct connection do you have with those investments if you run into an issue where you're too close to what's happening and exercising too much control over the trust? I was just kind of curious from those two angles.
Yeah, this is a good question. So I'll cover the second one. So yeah, we're typically only putting in front of you what we're either personally in ourselves, right, or whether our trusted clients are in ourselves. And we're working with you as if you're the note holder in this scenario, what you know, like, and trust, right? Based upon your risk tolerance, your comfort level. Some people made a lot of money in real estate. Some people made a lot of money in the stock market. Some people never want to touch real estate ever again. Some people don't want to touch the stock market, right? So some people want to be a little more aggressive in some alternative other investments beside those two things. And so it's not a one size fits all. It's customized. And I think this also helps to share how transparent we are. We are live to the entire world right now, and we're accessible, right? And so we work really hard to be accessible, to be available. Some clients we're talking on a daily basis, especially in the beginning. Some it's once a quarter. Some it's like once every 6 months. But our doors are always open. Our cell phones, you get a direct cell phone when you're a client. You can schedule Zooms, really any time of the week. So that's pretty accessible. We also do live events, or we speak at live events, and we invite people to attend with us to meet other business professionals, other potential investment opportunities. In fact, coming up, there's a couple I want to tell you about right now. This is a great opportunity. In San Francisco, September the 6th through the 8th, it's called the Family Office Club. Big opportunity to spend time with myself. And in fact, Jake Carpenter's going to be there. We're squeezing or twisting Jake Miller's arm to see if he's going to be there. Clients of mine will be there. Potential clients of mine will be there. My brother, CFO, will be there. So it's going to be about 7 to 10 of us hanging out at a conference that has about 500 other investors and private family offices and cool stuff. So that's a cool opportunity to get face-to-face with us. I'm flying from St. Augustine to California. Then there's a second one coming up in November in Ponte Vedra Beach. And that's at one of the DLP Wealth and Legacy events. I'll be speaking at that conference. Same thing, strategic alliances. Clients will be there, potential clients will be there, and probably another 500 other amazing people that will be there with DLP Capital. So you can also let me know if you guys want to be a part of either of those. Would love to have you join us. So does that make sense, Wes? Any answer your questions?
Yes, thank you.
Absolutely. Absolutely. Great. All right. So that's all I have right now, unless anyone else has any questions or thoughts. Otherwise, we can make it a great Friday and go enjoy this last 8 minutes before the top of the hour. You have something else to do. Micah, if people want to reach out to you and Jake Miller, where can they find you?
Yeah, our website, strategictaxsolutions.com.
Fantastic.
Or our 800 number, 800-773-1848.
1848. Jake Carpenter, if people want to find you, where can they find you?
They can reach us at carpentercapitalllc.com or 509-396-5292. Carpenter Capital.
Perfect. CarpenterCapitalLLC.com. I'm updating the notes here on my end. That's good to know. That has been updated. And if people want to find me, you can go to capitalgainstaxsolutions.com. You can also search on Instagram or LinkedIn, Brett Swartz. Love the opportunity to connect with you there. Facebook as well, Brett Swartz. And we also have all of our podcasts. You can go to iTunes or Spotify, Capital Gains Tax Solutions. Thank you so much for listening. We so appreciate everyone out there. And we will be back next week, same time, 10 a.m. Pacific time, 1 p.m. Eastern. Thanks, everybody. Bye now. All right, everybody. Good job. Bye.